Okay, awesome.
Okay, can you see? Okay.
Yeah, that's good.
All right. So let's start from the basic. I'm just going from the basic. All right. So basically, starting with the definition of an option trade or an option contract. You can find a definition on Google, which is kind of basic. But just to make it a little bit easy, it is an option contract. It is actually just a contract between two parties where they agree on a certain price to which one of the party can purchase a security, and that contract has an expiration time or an expiration limit, and it has a specific price to which they can purchase the security. So an option is actually a contract which you can find in many securities, such as in stocks, as well as in insurance and so many other securities. So just to make it a little bit, I'm going to do a little bit some drawing here. So two parties, let me here we go. Two parties that agrees on buying a stock, like a security for ours. For in our circumstance, we're going to talk about stocks. So let's say they agree on buying the a stock or ETF for SPY, and they can agree to buy the security at a certain price, which can be the actual market price, or it can be a lower price, or even a higher price. Let's say, for example, right now SPY is trading at $10. But this buyer says, okay, I believe SPY is gonna go higher in 2 years. Now he wanna get in a contract with the seller and say, in 6 months, I wanna buy 100 shares of SPY from you at $50. So let's say this guy is believing that in 2 years or in 6 months, the SPY will be selling at maybe $100, for example. And he believes that if he gives somebody right now, he if he gets somebody who can sell him SPY, or who can agree on selling him SPY shares at $50 right now, he will be in profit in the future. So now this what's gonna happen is that this person gonna ask for a premium. This person gonna ask for a premium in order to enter in this contract. Now, this guy can pay that premium and he gets in the contract with the seller. And then when it gets to the expiration date, he has the right to either purchase those shares, or he can let the contract expire without exercising the contract, which means at the time of at the expiration date, the buyer has two choices. He can either proceed and buy those shares at the struck price, which is the $50, or he can let's take for example, if after the 6 month the SPY is still trading at, let's say for example, $30. He went into a contract where he was able to buy it at $50. Why would he want to buy it at $50 anymore when it's still at $30? So he has the right to not proceed with the purchase. However, he will lose the premium that he paid in the beginning in order to enter in this contract. Okay.
Yeah.
I hope that is a little bit clear, right?
Yeah. Can you just explain a little bit what is the
Okay.
premium? I got a bit lost with the premium.
Oh, okay. So the premium is the fee that the buyer pays to the seller in order to get in this contract. because what happened is that the seller, when the seller gets in this contract, that means whatever the price that's going to be, he sold his right to those shares to this other person until the expiration date. So, in order to take that risk, he asked for a premium. Okay. And this premium, the premium actually is lower than the actual value of the shares. And every option contract is consist of 100 shares. So for example, if you look at the market right now, you can see an option contract for SPY can be around like 195 when the SPY is even trading at, let's say, $200 or $250. So when you pay the 195, you have to multiply it times 100, which is $195. You pay $195, but you have control on 100 shares of the SPY. If you were to buy the 100 stocks of this SPY, you would have to pay 195 times 100. But when you buy an option contract, you pay just the premium, which is way lower. It is about 1 times 100, but you have control over 100 shares of that specific security. And when you get in that contract, this money that you pay here is called the premium, and this premium is non-refundable. So when you get in the contract, you pay it, and it's like if you lose the trade, you automatically lose it. You cannot wait for it to come back to you or whatever. And the seller who accept the risk, they get credited that amount in their account before they even sell you the contract, before they even sell you the stocks. And if they get to the expiration date and you want to exercise your contract, the seller will have now to send you or to sell you the shares. You will have to pay the price for the full shares, and he will have to sell you the shares, but he will also keep the premium that you paid before. Okay.
Thank you.
So just to make sure we understand like few important components of the option contract. The first thing to understand is the strike price. The strike price is the price to which you agree to buy that specific security. So as of this example that we used previously, the SPY can be trading at $10, but you can agree to buy it at $50. You don't have to buy it at the actual price on the market. You can buy it at a lower price or even at a higher price. You decide the price. That's the strike price. And you have to really understand that in order to make your strategies clear and be really efficient in your trades. And then the premium, as I explained, is the price that you pay for the contract. The price that you pay to get in the contract. And that is debited from your account and is credited. It is debited from the buyer and it is credited to the seller. Okay. And the other very important thing is the expiration date. The expiration date, which is the date to which the contract will expire. At that date, it is usually every Friday. So there is multiple contract. Let's take an example. I'm going to open my chart here to show you guys some of the options. Okay, let's take five. Okay, so I'm here. Okay, so I have Apple options open here. If you look at up, this is the strike price. If you look on, you guys are seeing this, right? Bruce?
Sorry if I can see your screen.
You can see it, right?
Yeah, we can see your screen.
Okay. So, okay. So if you look at Apple right now Apple is trading at 450, 450.91. But when you go to options, you can see that in options there is different multiple prices that you can buy an option for. You can buy it at 430, 435, up to 470, and you can even increase. I think you can go even higher than that. Let me just increase that. Okay. So you see you can even go to 190, 190, 195, 200, and so on. And it goes all the way to 800. Okay. So you actually just choose based on the prices that are given by the company. You can choose to what price you want to exercise your option contract. And the other thing now that you have to understand, which is very important. So let me show you the premium now. When you see this, for example, let's say you want to buy the 430s, the 430 contract. If you want to buy this one, let's say you want to buy a call. The call are the left side and the puts are the right side. If you want to buy a call, you can buy it for $22.15, which is $2,215, and you will have access to control 100 shares of Apple, and you will only have to pay $22.15 as a premium. And this one is actually in the money already, which means it is already in profit. It is already below the current market value because the market is already at 450. So this when they show you the bid here, which is the 22.15, that is the premium, and that is a premium for the buyer. The buyer will have to pay this to the seller. And if you are selling puts, these are the premium. If you want to buy a put, these are the premium that you have to pay to buy a put. And if you are a seller, this is the credit. This is the premium that will be credited if you sell a put or if you sell a buy. If you sell a call. Okay. And as you can see here, there are multiple dates here. There is this August 14th, August 21st, August 28th. These are the expiration dates, which means if you get in this contract, you will have to exercise this contract before August 14th or the latest on August 14th before it expires. Now you have the right to exercise the contract before the expiration date or at the latest on the expiration date. And you also have the right to resell the contract without exercising that contract. So for example, let's say you found that you bought some calls here. Let's say you bought these calls at 430 when it was still at 440, and you bought the let's say when it was still at 400, you bought the calls at 430. You bought them at, let's say, 10,000. Yeah, around. So let's say you bought them at 10, and now they are selling at 22, but you bought them at 10. You don't need to wait. You don't need to wait for the expiration date to buy to have the full amount, to buy the full stocks and then resell them on the market. But you can just resell this contract because you bought it at 10,000, at 1000, but now as it's worth 2,000, you can resell it right now and gain the difference between. So you can actually just trade these contracts themselves. You don't need to exercise them, because sometimes people can be confused and think that they really have to exercise this, but you don't have to. You can resell that contract. Just make sure you do that before the expiration date. Okay. Now another thing. Here you go. So I showed you the strike price, the premium, and the expiration date. Now, another key thing that we need to understand is what exercising a contract means. So exercising a contract, what it actually means is once you get in this contract, you have the right whenever you want, you have the right to exercise that contract, which means you ask the seller to sell you those contracts, which means to exercise it. Now, the assignment, it means what the seller will get in their dashboard will be that they will receive an assignment from the broker, an assignment which says this buyer wants their stocks. So they have the right, they have the obligation now to buy those shares, and if they don't have them, to buy them and sell them to you. Or if they do have them, they have the obligation to sell them to you as you exercise your option contract. And as I said, the right is what you buy, what you pay for with your premium, which is the right to exercise it and the right to those shares. And the seller, with the credit that they received, which means they have now the obligation. They sold their right, and they have the obligation to answer to your request when you will send it, if you do send it. Another thing that we need to understand is the ITM, which is in the money, OTM, which is out the money, and ATM, which is at the money. So ITM means in the money, which means you buy something, you buy an option which is already in profit, or is, let's say you are bullish in a market. If you buy something that is lower than the actual price, that means you are in the money. For example, right now, the stock is trading at 450. If you buy something at 430, you buy a call at 430, that means you buy an option which is in the money. As you can see here, ITM probability, which means the in the money probability. So if you buy something right now, if you buy a 430, which is in the money right now, you are buying an option which is in the money. If you buy an option at 450, that means you buy something at the money. If you buy something at 470, because the price has not been reached yet, that means you buy out of the money. Now, the hedge that you have to understand here is that when you buy something out of the money, it is still a little bit lower than something which is at the money and the contract that it is within the money already. So all these contracts I can say they're even overpriced right now. But the other ones that are out of the money, they are still a little bit more understandable in terms of the price. Okay. Now, the ITM probability is something very, very crucial when you're trading options. And what this means is the company and the brokerage, like all these companies, they put together historical data of the underlying security, and they have probability. This is calculated probability of the stock getting to the strike price. So let me show you, for example, here, I'm gonna go to August. Let's go to September, for example. So if we go to September, they tell you by the end of September. So this is the ITM probe, which is ITM probability, the in the money probability. It tells you the probability of the price to get to your strike price. So it tells you the probability of the stock price to get or to be at your strike price. Now, this is from what you can see here, for example. They tell us there is 68% for Apple stock to be at, yeah, there is 68% for Apple stock to be at 430 by the end of September 4th. It tells you there is 68% of it to be at that price. To be at that price or higher, because it is a call. So to be at this price or higher. And they tell you now there is also 32% for this stock to be at 470 by the end of September 4th. Okay, so this is very, very crucial because when you really understand this, it's really helps you. It's really help you reduce your risk and be a little bit more precise in your trades. I will explain you this again later. Um, and another vocabulary that we need to understand is the implied volatility. So the implied volatility is what you can see here. It just tells you how volatile this actual option is. So there is when it's lower than 70%, it is still reasonable. But as soon as it goes higher than 70%, that means there is too many people who are trying to buy that option, and that usually drives the price higher. So one of the age that I use is when the volatility is high, I sell the options so that I can get the credit, which is a little bit higher than when the volatility will go back down to normal. And usually this is done in the morning at from 9:30 to 10. The volatility is really high. You see that pretty much everything is above 60 up to 80%. So when the volatility is high, the implied volatility is high, the price goes higher too. The price goes to overrating actually. So people are paying more than what the thing is actually valued at. And the way that you can only benefit from that is if you are actually trying to buy is to wait for the volatility to slow down, and then you can get in the market, or to sell at the high volatility and benefit from the fact that people are just rushing into it. Okay. And now we're just going to look into the difference between stocks and options. I will talk about the advantages of each of them. So actually the two big difference, they goes back to two things. It's just the leverage and the fact that it gives you choice. Options give you multiple choices of when you are trading, and it also gives you leverage. What I mean by that is when you're buying a stock, you can only buy a stock up to the money that you have. But when you're buying an option, you pay a premium, but you control up to 100 stocks or 100 times your premium. Okay, so it's kind of trading at 100 times your money. Now, the other, just talking about the stock first of all, talking about the upside of the stock, the upside of the upside of trading stock is that you have unlimited time to be right. So let's say, for example, you bought Apple, you buy Apple when it's even if you buy it right now, for example, if you buy it right now at 450, you have unlimited time to wait for it to go higher than the 450, which is which is not the fact in options, because options you can buy it at 450, but you have an expiration date. If the date of the expirations arrives before it goes higher than 450, you are actually in negative, and you're gonna lose your premium, and your contract will not be beneficial to be exercised at all. And talking about the downside of a stock is the fact that you only have when you are trading, you have two choices. It's either buy or sell, which is going higher or going down. And it has been proven mathematically and historically that when you are trading, it's like you have 50% chance of winning and 50% chance of losing your money. It's a 50-50 game, unless you have additional stuff now, additional things that you can add in yourself, like technical analysis or information or whatever, to add your edge in the market and be a little bit and increase your chances of success. But as it has been proven, when you are trading stocks, you have a 50% of losing, 50% chance of losing, and 50% of winning. And also the fact that it requires a lot of liquidity. If you want to control 100 shares of one company, you need to have 100 times the stock price of that company. And that's a lot of money being put at risk in order to control that specific stock, or in order to trade that specific stock. Now, in regards to options now, the upside, first of all, is the leverage. With a small premium, you can control 100 shares of a specific security. But of course, you can also lose it, because with leverage, there comes profit, and of course, there comes risk as well. However, the beneficial side of this is that your risk can be limited. When you understand what you are doing, you can limit your risk very, 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 very well, actually. And another thing that is kind of the upside of trading options is in terms of risk management. You can calculate your percentage of certainty when you are buying a specific option. As I told you, for example, with the implied volatility, if you want to buy, let's say you want to buy, let's take an example of selling a put here. Let's say you want to sell a put for Apple from let's say you want to sell a put from Apple for Apple at 470, for example. Now, what you can see here, based on mathematical and historical data, it tells us that you have 67% of the price, 57% chances of the price to be at this strike price, which is 470, or above this, which means actually, if you are selling, it's going to be 470. It can be at this strike price or lower. So which means you have 67% chances of being right. This is based on historical data. This is more than the 50-50% chances that I talked about when you're buying a stock. When you're buying the stock, you're just waiting for it to go high or low. But when you're buying an option, you can see how much percentage of success you have for this for your trade to be in profit actually. So this in the money probability is something very, very crucial when you are trading options, because it can tell you exactly how you are like what is your exposure in the market. Because when you understand the chances that you have, you can definitely be like, I don't know how I can tell you this more, but I don't know how I can emphasize this more, but when you understand, I have 70% of success on this trade, why wouldn't you proceed with it? If you know you have 30% of loss on this, or let's say 30% of success on this trade, why would you proceed with that trade? So that is what it's actually saying. It actually tells you. It just gives you a little bit more confidence in proceeding with your trade. Now you just need to play with the price and know how you can put some strategies on it in order to make it even more profitable or even more safe for you. Okay, another thing that is kind of an upside.
Sorry, Emmanuel.
Huh?
It seems that there is a question for you, because
Yes.
it seems that someone cannot see the percentage that you're referring to. I'm not sure. I just ask if it's possible to maybe give more details about the question, because like there is the percentage of the right. I assume those are the percentages that all good accounting is referring to. But yeah, I'll see if there is more details. If you can maybe ask more details about the question, that would be great. But I guess for now, Emmanuel, you can keep
going. Okay. So yeah, if you didn't see them,
percentage of confidence. Can you show what is again the percentage of confidence?
Okay. Yes, the percentage of confidence, which is this in the money probability. You can see here, right? Here, where my mouse is. Here, ITM prob, which is the percentage, the in the money probability. It tells you how much you can. If you see here, down here, there is the percentages here. So it tells you there is 31%, 31.94% of this price, this stock, to be below 430. So the right side here, these are puts, and the left side is the calls. I will explain what the puts and the calls are, but just to give you a heads up, like to explain a little bit, the ITM probability shows you the percentage that you have for the price to be, for this strike price to be the same or lower for explaining a little bit difficult here. But anyways, what I'm trying to say is that it tells you exactly how much percentage we have for this underlying stock to be at this strike price. Because right now it is trading at 450, but now they can tell you how much percentage you have for this stock to go back to 430. That's what it means, this percentage here, because it is a put. But there is also 68% for this price to go to be above 430, because this is a call. A call is for up, a put is for down. So you buy a call when you believe the price to go higher, and you sell a put when you believe you buy a put when you believe the price is going lower. I will be back to the put and call later. I hope I showed you where to see the percentage of confidence here. ITM probability. You can see it right here. ITM probability, it's right here. It tells you the probability of the underlying stock to be at your strike price.
Okay, that's good.
It is different for each and every strike price.
Yeah, that's good. Thanks for that.
Let me see.
You can keep going.
Okay. Can I keep going?
Yeah, that's good. You can keep going. That's perfect.
Okay. Now, another thing that another upside of trading options is also the fact that you have multiple transactions that you can proceed or you can execute to reduce, first of all, to reduce your risk, of course, and of course to increase your reward. So I'm going to explain what we have as kind of transactions that you can exercise with a stock or an option. For a stock, you only have two options. You can either buy a stock or sell that stock. You buy a stock when you believe the price is going higher, and you sell a stock when you believe that the price is going lower. Now, for options, you have multiple options. You have multiple possibilities, actually. So you first of all have what we call calls. Calls are the contract that you get in believing that the price is gonna go higher. So you get in, when you buy a call, it means you believe that the price is gonna go over your strike price or above your strike price. Then you can buy a call, which means you are long in that trade. You are long in that company. And when you buy a put, it means you are negative, or you are believing that the price will go lower for that specific stock. Now, another thing that you have different things that you can be in that contract. You can either be a buyer, you can be the buyer for the call, or you can also be the seller. And you can also be the seller. So this is two things that you can be for the specific action. You can actually be a buyer or you can be a seller. And for the puts, you can also do the same thing. You can be a buyer or you can be a seller. Which means when you buy a call, when you are a buyer for a call, you pay, they debit your account, they give it to the seller, and that means you believe that the company will go higher. But if you believe that the company will go low or will lose value, the share will go lower, you can sell those calls. And those people who believe that the company will go higher, they're gonna pay you credit, they're gonna pay you premiums, and you receive those credits for them to get in that contract with you. And then at the end of the day, or at the expiration date, whoever will be right will be the person in profit. And another thing for options is that you can exercise multiple transaction, or what we call multiple legs transaction for the same stock. So, for example, you can buy a company. You can buy a company at let me just see. You can buy a company here. Let's say you buy it at $10, and you can sell that same company at $20. So this is one of the strategies actually that we use. And what this does is that you give yourself a neutral position in that company, a neutral position in that trade, which means you believe that whatever the movement of this company gonna be, as long as the company stays within this range here from 10 to 20, Even if the stock goes high, low, whatever, sideways, or whatever it does, as long as it says it stays in this range, you will be in profit. So when you position yourself like this, it means you are neutral in a trade. You don't know if it, you don't believe it's going higher than 20, and you don't believe it's going lower than 10. That's how you can be neutral in a trade, actually. But when you're trading the stock, you cannot do that at all. You have to pick one position. And this is one of the multiple legs that you can actually do. Multiple legs trade, that we call them multiple legs transactions. And this is what I was talking, what I'm talking about when I'm saying that you have multiple choices when you are trading options. You don't only have the specific price to enter the market from, but you can enter at a higher price or at a lower price, and you can even do both to help to give yourself more choices to move around. Okay, so one of the things that this is going to be a little bit advanced, but one of the things that you can do. So one of the things that I actually do personally, I usually look into selling options, which means I'm going to receive the credit, I'm going to receive the premium. I like that, receiving the premium, because some of the times people just don't exercise their options, and then when they expire, I just keep the premium. And of course, I always look at the in the money probability. So this is going to be a little bit advanced. But what you can do, you can sell a put at a. So another thing that I want to mention first of all is that every time I'm trading options, I'm looking at the 70% probability. Another thing that you can actually notice here is that the higher your probability is, the higher your price will be. The lower your probability is, the lower your price will be, and of course, the lower your premium, the lower the premium will be. So for me, for example, as I'm a seller, if I'm looking for something which has low probability, they're gonna give me, of course, lower, like a low premium, because they know that there is 70% of chance. So there is 70% chance that I'm gonna have to keep that money because I will be right. So they give me low credit or low premium for that. And if you want to be 100% or 70% or 90% right, they're gonna charge you more, or you will have to pay more. And of course, if you are the seller, because you're gonna lose a lot when you go into that trade. What I say by losing a lot, I don't mean you're gonna lose a lot of money, but you're gonna lose on the opportunity of staying in that trade. So they pay you more premium. So the higher your probability is, the higher the premium gonna be. If you are the seller, you're gonna receive higher premium if you are selling options that are a higher probability strike price. And the lower it is, the lower the premium gonna be, and the lower your credit's gonna be. So one of the things that I do sometimes is that I can combine two transactions. I can combine a call and a put, because I'm always looking at a 70% probability of winning. You can combine a 35 and a 35 to put yourself in a neutral position in a trade, and you will be right. Anyways, we can go into that later. But as of now, did you guys have any other question? Just to make sure all of us understood this basic.
So there is one question. Do you have the names of those strategies, or do they have a name so we can look at them online?
Yeah. Oh yeah, sure. Sorry. I can write some of the names down there. There is what we call like a credit spread, a debit spread, a vertical transaction. Let me just take the, hold on. I can send some of the names later.
Okay, that would be really, really interesting.
So,
So yeah, thanks for that. If you have questions, please send it to the chat. Just, I have one question for you, Emmanuel. Just what you would suggest, like in terms of, well, we have the choice, like should we go invest directly into stocks? Should we go for options? What would you suggest? And like, is there one that you would say that it's better to do, or?
yeah. So personally, I kind of personally what I do is that I invest 25% of my portfolio in options, and of course the rest I put it in stock and other investments, just as a leverage, not a leverage, but like to diversify my portfolio and just to have a backup. But of course, there is a lot of upside actually in options, and one of the other thing that is very crucial in every investment, as you know, is information. Wherever you can get the most valuable information, you need to act on that information. I still like and love investing in stocks because you can, like, for example, one of the things that I do, all of you know about that. I invest with like the insiders transactions. When I have an insider transaction, I don't know when exactly the move gonna happen. If I go and buy an option, I will be limited in my time, and my options can expire before the move happen. So I go back and buy a stock when I'm trying to trade on insider information rather than going on an option. When I don't have any specific information, I can definitely just base myself on the option side and trade the options. And also another thing is when you're trading a stock, you of course have those technical analysis that you can combine with when you are trading stocks, and you can combine them, of course, with options as well. So it's what I can say is definitely diversify, put a little bit of your capital in options, and just as you're growing, you can see how it's going, and whichever performs well for you, you can invest more into it, more into options or more into stocks.
Okay, there is something great that Monica mentioned. It's that during earnings, what she does is that she buys a call and a put, and basically I assume that it's trading the event, right? So with options, have you ever done that before, like just
Mm.
trading any type of events instead of, like as you said, going into stocks and waiting for the insider to say something?
Yeah, so as she mentioned, actually on the earnings date, of course, a lot of people are waiting for the earnings, and a lot of people there will be which means there will be more volatility in the stock, and of course in the options as well. So I can definitely use that. I haven't specifically thought of it and use it, but when I'm trading, I look at the time when there is high volatility to definitely sell those options and benefit from the fact that there is a lot of people in the trade, and they are definitely willing to pay whatever is asked to get a piece of the pie.
Hmm.
So it's a really good age that she actually mentioned and should be used.
Hmm. Okay. Well, thank you very much, Emmanuel.
Yeah.
I don't know if anyone else has any questions. Would it be possible to actually have the PowerPoint you shared, or it's possible to go over it if anyone is would like to know more?
Yeah, for sure. I can share it. Hey, actually, I have one website that where you can also get more details, and It's a free website where they actually give a lot of information about option trading. It's called Alpha Option, I think.
Okay.
Alpha Option or of Option Alpha. Yeah.
Okay.
I will share this PowerPoint, but it's real. This PowerPoint is definitely very, very limited in terms of information. As you can see, I just put like the words in there.
Hmm.
But if you go to this website, for example, it's a free website. You can learn a lot more, and of course, you can also learn more other information on YouTube and readings and stuff.
Hmm. Okay. Thanks. Do you think you can add it to the PowerPoint, the website once you find it, the alpha option? So maybe at
Yes,
the end of
yes,
the
no
PowerPoint,
problem
that
at all.
would be
I will
awesome.
do that.
Okay, great. So yeah,
Mm.
thank you very much.
Actually, I would like to mention one thing.
Yeah.
Uh, yeah, just to mention one thing, it is very, very important to understand the key, like the keywords of options. There is one guy in the US who committed suicide recently. The problem is they received, so the guy was trading options of one of the companies, and he bought some puts, and then when he went back to his account, he found that his account was around minus 700,000. So he was really scared about that, and he panicked and killed himself. But the thing is, he did not understand what happened is that the put that he was exercising, the put that he bought was just exercised by the buyer, which means the buyer sent a request to his account for those stocks. And what he only had to do was to exercise his call, because most of the time, of course, in order to limit that risk, that type of risk, was you can sell some puts and you buy some underlying calls to reduce your risk. So he had that in, but he didn't understand the fact that he has to exercise his trade as well. So he didn't exercise it, and he just saw the big transaction in his account before even thinking twice. He went ahead and do some crazy stuff. But it is so, yeah, that's why I say it is very important to understand what it is exercising, assignment, expiration date, and all those keywords in order to be really safe in this trading.
Okay. Well, thank you very much, Emmanuel. It was really great.
Awesome.
Yeah. So I assume no one else has questions.
No worries, man.
If you have questions, please you can send it to the chat on WhatsApp, and otherwise just ask Emmanuel directly. So that would be great. So yeah, thanks everyone for
Mhm.
joining, and please, Emmanuel, if you can share the PowerPoint after, would be awesome. So everyone has a great evening.
Yes, for sure. I will send it in the chat.
All right. Yeah, everyone, have a great evening.
Awesome. Thanks everyone for coming.